Boom.
There we
Hello.
go.
We're here. Great to see y'all.
Likewise.
Yes.
We've been getting a wonderful roll call from folks literally around the world. I saw London, I saw Honolulu, all sorts of Miami, Charleston, all over the world. This is really great to see. And since we're getting going, I think we're ready. We'll go ahead and dive right in. So my name is Mercedes Bent. Thank you all so much for joining our panel today. And this is not a normal panel. This isn't a bunch of people pontificating and agreeing with each other and saying, you know what, that's a great point. I'm going to say the same point. This is going to be much more informational. We're going to have some of the best VCs in the game giving you their thoughts about how they would look at deals. And so if you came to this event last time, there are going to be some similarities in terms of some of the companies presented. Largely, they're the same. But I think what's really interesting is actually hearing it from a different perspective. And so, there's lots of smart people that can reasonably agree and have different opinions on even the same company. And so I think that's also helpful to have some of that flavor. I will go ahead and let the panelists quickly introduce themselves, and then we will dive into the case studies and frameworks. So why don't we kick it off with you, Jillian, if you don't mind introducing yourself, where you work, what stage you focus on, and anything about your background you want to tell us.
Yeah, absolutely. Hi, everybody. Great to be here. Jillian Williams. I'm a principal at Cowboy Ventures. We are a pre-seed and seed stage fund. I'm based in New York, although I think most of my fund is actually based on the West Coast. And we invest primarily across the US, or really any companies that like primary operations are focused on the US. And so great, excited to chat with you all.
Next, let's go with Kerby.
Sure. Hey, everybody, Richard Kerby, general partner at Equal Ventures. We're a seed stage fund based in New York. It's a $55 million fund, and we are a generalist firm, but we spend a lot of time focusing on what we call legacy markets. And so think of categories that have not yet become tech-enabled, like insurance, logistics, retail, e-commerce, childcare, elder care, et cetera, a couple of categories that we spend a ton of time in. And before founding the firm, was an investor at Venrock for about 5 years. And before that was a firm called IVP in the Bay Area doing later stage deals.
Great. Peter, to you.
Okay, rock and roll. Great to see everyone. And hello from Clinton Hill, Brooklyn. My name is Peter Boyce. I'm the founder of Stellation Capital, which is a new early stage firm being built here in Brooklyn. So $40 million fund investing in incredible founders really early on. Prior to this, I spent 8 years at General Catalyst, the multi-stage, multi-billion-dollar venture capital firm where I was lucky to open their New York office. And before that, I co-founded Rough Draft Ventures when I was a student to help get students capital for their startups. So great to see everyone.
Great. And one note today, we actually will only have case studies today focused on seed and A. Apologies in advance if you were really dying for the growth. Realized that we forgot to take that out of the announcement, but hopefully you'll get some value out of that. And honestly, the numbers don't mean anything these days. The companies are all, raising at different metrics and letters.
Growth is boring anyway, so don't worry about it. You're not missing anything.
Couldn't agree more. So sorry for the growth folks in the room. I will go ahead and share my screen and get us started. Hold on one second. I'm actually not seeing the screen I want to share. Oh, here it is. Okay. So let me try and present. Can everyone see my screen? Can you hear me now? Okay, great. So this is us. We just introduced ourselves. And in terms of what we're going to be talking about today, we'll go through some cases. There's going to be 3, each led by the 3 wonderful panelists, and then we'll have some time for Q&A. I think we have blocked until 2:15 Pacific. So I want to confirm, panelists, do you have until 2 p.m. or 2:15?
I can do 2:15.
Yeah, good to go.
Okay, great. And yes, feel free also to, ask questions in the chat as we're going. The panelists might see it and be able to address as we're going, but we'll also have time at the end. So this is us. These are wonderful pictures. And before we dive into the first one, which is going to be led by Jillian, just a note, on some of what I just mentioned in terms of, okay, the numbers and letters don't mean anything anyway. It's always changing. If you ask somebody what a Series A deal was 10 years ago, they might have told you, well, it depends also where you're asking the question. Are you asking it in Silicon Valley? Are you asking it on the East Coast? Or are you asking it in a different region of the world? There's all these different ideas of, thresholds and metrics that people have. But if you zoom out and really think about it, there's kind of, a couple of different more milestone-based things that you can think of. In terms of the pre-seed, the goal is really, you're just getting going. Pre-seed also wasn't a term a little while ago, but you're just getting going, figuring out what your product is going to be, or even what the thesis is going to be, the value prop. When you get to seed, it's more around actually proving and finding that product market fit. And I'm sure some of our speakers will talk a little bit more about what product market fit means to them. But, do you have a consistent way to sell, and that your product is hitting a note? And then Series A, B, all the early stages of Series A and B are about hyper growth, turning that initial product market fit into a scalable, repeatable way to grow. And then once you get to growth, which is more C, D, E, it becomes more about optimizing, making sure that you're getting a lot of the unit economics and metrics to kind of hit thresholds that will prepare you to build a long-lasting company. So quick little overview there, but you'll see us refer to and talk about these terms a couple of times. So I want to just start with that. And after that, I will hand it over to you, Jillian.
Perfect. Thank you, Mercedes. So before going into the first case study, I just want to touch upon sort of how we think about evaluating a seed stage deal. And obviously, Peter and Rich, if I'm missing anything or you want to add on, please feel free to jump in as well. But I think these are really the 5 main categories in terms of like how we're going to think about any deal or company that we're looking at. And first and foremost, especially when we're talking about seed, what we're really going to think about is team. I think team should always be important, but it's probably most important at the earliest stage. And then like you can kind of say maybe gets a little bit less important, or other areas get more important. But the team, just because usually at seed, especially today, like very little is built. Oftentimes there could be no product. There probably is no revenue. And so you're really betting on these people in terms of, are they, this vision that they have, are they going to be able to execute on it? Do they have the background to be able to build this? And sort of why do we think that they're going to be the ones that can really win in this market if there's a competitive market in there? And like what gives them sort of that unique ability to do so? And so when we're looking at this, the team, I think it becomes even more important when you think about how many things can go wrong when building a startup, and that not everything is going to go perfectly up and to the right. And really, as we think about some of the challenges that they could face, like how are they going to be resilient? And then I think for me, one of the really important things that I always like to think about as well is how are they able to attract other talent, and how do they think about attracting that talent? Some of like the best founders person that I've invested into are just talent magnets and people that people want to work for, and they're really able to understand where their weaknesses are or where others can really complement their skill sets and really bring in that talent and retain that talent as well, and bring them up. And so I think that, so team becomes probably the most important for us when we're looking at it from a seed perspective. Next is really around like the market opportunity. So like, what are the market dynamics? What's the sizing of this? I think you'll always hear about from a venture standpoint, it's like, can this be $1 billion company? I mean, now we're seeing decacorns and much bigger companies, but like, how big can this be? And a lot of that comes from just like the economics of how venture works and like what type of return most funds need in order to really return our fund. So if we're going to own 5%, 10% an exit of a company, if you're going to own 10% of $1 billion company, you can get $100 million. Like, so for a $100 million fund, you return your fund in that. And so really thinking about what's the market opportunity, how big is it, what does it look like today, and are there sort of the ripple effects that it can get bigger? I think the classic example that people always use in this case is Uber, that initially when people were looking at the sizing of Uber, they were looking purely at the cab market, but not thinking about how Uber could actually expand that and make more people who never thought about taking cabs actually start taking cabs. And so like, what does that look like? What does the competitive landscape look like? And are you really solving a problem that exists? I think one of the challenges that we see sometimes is you can have a really interesting solution, but for a problem that doesn't necessarily exist, or it can be kind of like a nice to have rather than a real need to have. And so I think when we're looking at the market opportunity, that becomes a really big question of this could be a really interesting company, but is it necessarily a venture scalable company? And I think that's one thing that talk to founders about a lot is that there are really interesting businesses that can make founders tons of money, but not necessarily venture scalable businesses. And not every company is meant for venture backing. And so just thinking about how big can this become and what can it look like is really important from the market opportunity standpoint. And then we go into product, obviously, sort of what are they actually building? How are they thinking about building it? Sort of what is unique about this product? What type of, are they, if a company is live, do they have product market fit already? Are they really finding the challenges of the user? And how much does the user want this and need to have it? I think this is like probably within the three main categories of like team, market, and product. We say sort of least important only because the product can change a lot in the early days. Like when you talk about companies pivoting, it could be a full pivot, it could be a minor pivot, but probably the product is not going to look exactly how it looks today as it looks when you were first pitched at the pre-seed or seed stage. And so really want to just make sure that the company and founders understand these pain points and understand how to build the product, but can kind of have the gist of like, yes, we're really solving a problem with this product. But I'd say from those three, that's probably what I don't want to say we care least about, but we do understand that is going to evolve over time. And we're constantly wandering around sort of like, what does that product roadmap look like? And what does it look like today versus what is it looking like in the future? And then, I mean, that kind of goes into the broader vision for the company and sort of how big is it going to get? And is the founder thinking big enough? And I think this is always an interesting question because you can have, especially at the early stage, it's a balance. You can have founders that come in and can be pitching you 10 million ideas that they're going to do all within the first few months. And like that can be a turnoff for VCs because you really want someone that's focused and can understand how to execute. But at the same time, again, you're pitching, you want to be backing a company that has the ability to be a multi-billion-dollar company. And so you really do like long-term want to understand what that bold vision is. And so I think that vision idea really ties into what the market opportunity is, and then also ties into what does that exit at some point look like. And so is it a public exit? I think someone in the questions was asking, you can go for a M&A and get acquired. But sort of obviously most founders are kind of targeting, at least initially, sort of that IPO and kind of being able to run a public company. And so it can really be both. I mean, there are some companies that aren't necessarily meant to be standalone public companies, and they have great synergies with other companies and can still have pretty massive exits via M&A, but really understanding what can that look like as a standalone company, I think is really important. And then, I mean, I think just to answer some of these questions as well, in terms of like that pivot factor, I mean, I think we understand that there's probably room and potential that a product might pivot. And I mean, that's kind of why at the earlier stage, when you think about deal, and that goes into the deal dynamics, why sort of the valuations are lower, we're taking a little bit more ownership, dilution for the founder is a little bit higher because of that risk that we're taking. We understand that there's a lot more risk, that the product might fail, that there's going to be a little bit more challenges that are not necessarily expected. And so we do understand that need to pivot. And I think that's where it comes down to the team again, sort of how do we think that they are able to react in different challenges? How can they kind of, how are they going to be able to be resilient and figure things out as they continue to move on? And yeah, so I mean, just want to make sure if anybody else has any other questions in here. All right, perfect.
Sorry, 1 second, trying to get to the right
Okay.
spot. Is this the right one?
No,
I think it's
it's the
beforehand.
fintech
Oh,
one.
okay.
But while you go there, one thing I'll just add to what Jillian was saying is that, every investor will have a different answer to the questions that Jillian's talking to, right? So there's some investors that say, all I care about is market or team or product or one of the three. And so, you want to kind of understand what your investor you're pitching to cares most about, and hopefully tailor your discussion towards that to give you the optimal chance to raise capital from that particular investor as well.
Yeah,
I should
exactly. Sorry, go
I should
ahead.
also note, sorry for the cases, some of them are reflective of companies that exist, but all the numbers for the most part have been changed. So this isn't the performance of any company if you recognize it. Jillian, we'll hand it back to you.
Perfect. Yeah, so I guess I'm not going to necessarily read through every detail of this company, but want to just kind of talk through how I would think about this. And so, as you see, it's kind of a fintech company in the trading space, really targeting sort of the investor relations for IR. And so I think the first thing for me is just thinking about what problem exists, and is this a real problem? So is it that the customer, so the retail investor, so let's say anyone here that uses Robinhood, do they care about having communications with the brands that they're invested in? And why do the brands care who's invested into them? And so what exactly is the problem? Does that exist? And how do we validate that? And so I guess when I would first hear that sort of problem statement, either I personally come from investment banking, so that is something that I could understand. I came from capital markets. I understood that oftentimes we had to run a lot of spreadsheets in terms of understanding who were the investors of companies, because they really wanted to understand. And usually they could see their holdings in terms of institutionals, but when it came down to retail investors, they really had no idea. And they really wanted to be able to figure out ways to engage the retail investors, to really encourage longer term ownership, to stop sort of short flipping. And so I think for me, that's one thing that I'll think of, okay, kind of check the box. Yes, this problem does exist. This is a pain point for investor relations teams within companies. Okay, kind of validating that would be the first thing that I would personally do. I think second, I'd want to understand then, why do customers care? And how are you going to engage the customers? And so I think in this case here, what is interesting about this company is that they kind of have a two-sided marketplace. So they're bringing value to the IR companies by giving them information for the retailer investors, but they're doing so by providing perks and incentives for the end customers, for the retail investors. And so the retail investors are actually getting something out of this. I think one of the questions I had for a company like this is, at what threshold do I need to have, how much do I need to own of any specific stock in order to get that sort of a perk? Is it 1 share? Is it 10 shares? Because I think that then can have an impact on the size of the market. I think you see a lot of Robinhood traders right now that might buy sort of $100 worth of any given share, worth of any stock. However, if you need to own $10,000, then does that decrease your market quite a bit? And so kind of understanding exactly what that target market looks like and kind of doing that sort of analysis to understand the sizing would be my next step in terms of who exactly would be the target customer for something like this. And I think if it's more of that sort of, you need to own $10,000, then what does that mean for this market sizing? How much smaller does that get? And how big is this able to get? And so I think that would be a big question that I would have personally. But I'd also connect that to, again, kind of back to the team and sort of how well do they know this space? Obviously, one of the co-founders comes from sort of investor relations background and understands this extremely well. And so kind of has that experience from the corporate side to understand this pain point. And then the CTO, it has sort of that consumer side. And so kind of having the having that relationship where you kind of get that consumer side as well as the corporate side for this particular company is super interesting to me. And I think that's where the company, where team, like sort of team company fit and team product fit becomes really important. Because it's not just that every person needs to have like sort of like a Stanford MBA or something on paper, but actually why are they the right team to be winning this market, it's specifically. And so in this case, I would want to, again, I want to understand sort of, I'd go into that market sizing and then would need to understand, okay, what is our go-to-market? Because one of the challenges I would think initially is that not only do you need to kind of acquire the customers, so the retail investors, but also you need to acquire the corporates. And so given you kind of have two sales cycles, that means two different sales teams, because those are pretty different sales cycles. And so what would that look like? How would we think about that? And how big of a lift would that be? And would this be somewhat competitive with some of the retail trading platforms that exist today? Would this be synergistic to Robinhood, or would it be competitive to it? Because I personally would not want to invest in something that was directly competitive to Robinhood right now. But if there was something that could kind of tap into the user base that they already exist, then I think that could be a lot more interesting from a customer acquisition standpoint. And so digging into that would be extremely important from my side as well. And with this company, I think what is good, even though it's seed, is that they have some traction. And so for our fund, in the way that I think about it, is there are some funds that have specific metrics that they're targeting, that they want to see 1 million in ARR or some sort of threshold before they invest. I think for me personally, I want to see trends. I want to see that you're finding product market fit. I want to see that sort of your ability to acquire customers is improving because you're actually understanding that customer need and the ability to acquire them. So I think for me, it's not necessarily, and I see a question around this, a ton of emphasis on specific AR, because honestly, for the most part, most of the companies at Seed that I've invested into do not have any revenue, but it's really just kind of understanding some of the trends around how they're able to grow the customer base and how they're really able to find product market fit that I'm looking to understand and make a bet that they're able to kind of continue to improve upon as they continue to grow. And then I think finally, I think the last part obviously that we look at would be the raise, and sort of just given where I think the company is today, how they're progressing, what I think the risk is, and like really where like the broader opportunity is really how I would think about sort of pricing this. Obviously, some of that depends on how much they're looking to raise. And so if they kind of have a fixed amount that they're really hard and set on in terms of $2 million or $4 million, in this case, it's $2 million, then that somewhat helps to set a round of valuation for you, typically somewhere between 20 and 25% dilution. And so from there is kind of how we would think about, or at least I personally would think about valuation for a company, but especially at the seed stage. Also, I think about it in terms of what does that mean for the long-term exit for this company? If it's a 10 million pre versus a 20 million pre, that can have a pretty different effect on my exit opportunity and how much I make back for the fund. And so kind of thinking around that, especially in terms of how big I think a company can get. And so those would kind of be the different dynamics in terms of how I would think about what goes into this. And throughout all of this, I'd probably try to do a number of different like potential customer conversations. So if I knew anybody in IR in different companies, would try to understand how they would think about this, maybe understand how, like, if Robinhood would be a go-to-market, how Robinhood would think about partnering with a company like this, and just try to do different reference calls on the founders as well as I was digging into it. And I think there were a few questions on the side.
And just in the And keeping with time, maybe we can come back to some of these questions at the Q&A as well,
Yeah.
so we can go on to Peter's case.
Perfect.
Thank you so much, Jillian. And the next one is Peter. Take it away. Oh, and actually, where did this get out of order? Okay, are you doing a Series A, Peter, or are you doing a seed?
You know, I was going to ask you, Mercedes, because there are aspects of this bad boy that, you know, looks like it could be a seed, you know, but it's got the traction of an A. It's got the setup of an A. So, you know, I'm happy to, you know, characterize it any way you'd like.
Okay, great. Well, maybe I think I had asked you, Kerby, to do the A framework. So
Sure,
maybe
no problem.
So why don't I? Yeah, maybe
Yeah.
I analyze this in the seed framework, and Rich is the best professor we could have on the Series A framework. You know what I mean? I'm going to be listening and learning. Okay, cool. And I'm just trying to like land as many of the questions in the Q&A too. You know what I mean? Like to the extent folks find that helpful too. But just one perspective. So really quick, so I think the framework that Jillian outlined, I think is an awesome starting place for just, you know, characterizing both seed and Series A opportunities. So let's, if we apply that framework to this business, you know, the first thing that I would say, I'm not even sure that I'm going to do it in order, to be honest. I'm going to, you know, from my perspective, let's go straight to the team. You know, I think Jillian mentioned a handful of key aspects with respect to the team that I think are so crucial. And if we use our seed lens for understanding this business, I think it starts with the people. So, you know, first and foremost, we've got two co-founders with backgrounds in art. Great. So they're familiar with the problem space. You know, they're kind of, you know, familiar with the ins and outs. The world of art is certainly one for which it helps. It probably, if you know some gallerists, you know some artists. Rich knows, you know, I spent a lot of time in and around the world of art. It's got a lot of nuance. So grateful to see that that's in their backgrounds. Two areas I would double click into immediately. Jillian used the expression founders, you know, looking for founders that are magnetic for talent. This is the first thing I look for. You know what I mean? Like, who are their advisors? Who are their mentors? Who are they learning from? Who have they hired already? And so I would be very curious to know who the extended team is of this business. And I think especially for the folks that are, you know, pre-seed and seed stage entrepreneurs, you know, in this video session, it's just like really dialing in your team slide, the set of advisors and the folks that are in your universe is really, I think, an important kind of proxy for progress. So that's the first area I zoom in here. The one open question I am having about this business too is just who's building the product, like who the CTO is or the VP of engineering. It's just like, you know, how are we actually kind of building, you know what I mean, some of the software, because hopefully maybe, you know, one of these co-founders, you know, was like a technical, you know, kind of, you know, maybe an engineering student who went to go work at BCG and blah, 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 blah. Okay, so that's where I would start on this one. Notice I haven't even talked about what the company does, you know what I mean, in a way. Like, you know, I appreciate that we've got like the outline on the slide, but like, you know, I think in terms of like, you know, prioritization, just the people is, you know, where I end up zipping to first in kind of assessing pre-seed and seed opportunities. The second, let's hop to the market opportunity, because again, I think, you know, one of those things, you know, if you're a 2 or 3 person company that is at the pre-seed or the seed stage, you may have nothing built, there may be no traction. So, you know, let's talk about kind of the way that we might characterize and assess the market opportunity. So, look, clearly we have a really good TAM, $28 billion sounds good to me. You know, that could probably return Rich's fund, Jillian's fund, my fund, Mercedes' fund a few times. So we like that, you know, so there's enough surface area, so to speak, to go around. And then look, I think this is also, I like the way that there's a timeliness aspect of just, you know, kind of the way the industry is operating or dealing with dynamics as it pertains to COVID. So I think being very clear about the why now for your business in the context of your market is really good practice. And especially if you can tease out the ways that why now creates opportunity for you. So if there's structural dislocations or tectonics, changes in consumer behavior, things like that. So I like that. So I feel like we're checked off on market size. The thing that I think we're going to double click into here, though, is just are there software businesses that have done a meaningful job of organizing any of this market already? So thinking about market structure, this is something that, you know, Rich is like an expert in. And so that's one of the questions that would be in the back of my mind is just like, you know, of that $28 billion kind of art market, how much of that is online versus offline? And who are the meaningful players that have organized any of that already? Because those may be our competitors, collaborators, blah, blah, But I'd like to understand that a little bit more. And I'm sure if I poll, this group, you know what I mean? Like, I'd be super curious to know how many of you bought, you know what I mean, art online, number one, and number two, how many of you have ever rented art? And then number three, at what price points have you done that? So I think that dovetails then into the product and the customer piece, right? Which is, this company clearly outlines the fact that on the supply side, right? So galleries having all this kind of excess inventory, there's no good way to necessarily monetize that. So I think that's credible. That makes a lot of sense. I think on the demand side, I think that's where it's probably helpful to double click into, is just to really validate, like, people want to be renting art. Do people want to be renting $1,000 pieces of art, $10,000 pieces of art? I mean, I would rent a $100,000 piece of art, you know what I mean, for $40 a month. You know what I mean? I would do that. Do I want to rent a $2,000 piece of art for $40 a month? Maybe not. So I think, understanding the amount of customer validation they did would be another thing that we double click into here. So, okay, let's talk about the solution for a minute. So again, I think we kind of characterized that. Again, I think one of the things that I would expect this business to do also is to kind of characterize the history of attempts, because this is like a known problem space. There have been a history of, folks that have tried to figure out rental marketplaces and things like that for art. So I'd be curious the way that they would kind of talk about the way their pricing comps against them. So $100 a month, more or less, than some of those attempts in the past. The other piece I think is, and they kind of talk about the way, that they're going to get the supply side, so the galleries and the sources of the art, so museums, all that jazz. But they don't necessarily go into detail about the way that they're going to aggregate demand. So aggregate, folks like us on this call. If we drop down to the traction piece, they call out, CAC is $300 a user, but what channels, you know what I mean? What's working? Facebook, Instagram, blah, blah, blah. It'd be good to understand the granularity there. I think one of the things that's really helpful to understand with businesses like this is just what their unit economics are. And I know Rich is going to get into this in the Series A framework. But I think, for what it's worth, I think Jillian kind of characterized, the product can pivot and evolve, and some of the decisions, around the business model and the product can evolve, but like out of the gate, do we have a good, healthy business? So, one of the things I would definitely double click into, so GMV at $2 million a month, per month, and I see a lot of questions, folks are kind of understanding, asking about kind of benchmarks. Benchmarking ends up taking place, I think, in two ways. One is it's businesses that look very much like the current business you're looking at, and then they're kind of, almost kind of based on stage and pricing, right? So, there are lots of magic numbers, 100K MRR, $1 million ARR, blah, blah, like all that jazz. So I know it's oftentimes, you want like a definitive answer around just like, well, if I come back to you with like this ARR or this MRR, like, are you ready to roll? And oftentimes it's just not an easy question to answer necessarily, unless someone's like really familiar with their business. So anyway, my key question here is just, GMV of $2 million per month could be incredible if the take rate on that GMV is healthy. But like, for example, just understanding like, well, how many of these pieces are they actually like able to kind of sell through? So like going from rental to actually selling, like, and what their take is and what the split is with the gallery. These are really important things that would kind of further characterize the health of the business. And then last thing, I'm doing like the speed version, Mercedes. I hope that's okay, because I figured we'll do the jam session in the Q&A and all that jazz. And I think Jillian outlined I think a lot of the key elements in the last case too. Let's talk about the setup. So this is certainly not a typical seed setup. It might be a 2021 seed setup, you know what I mean? Like, if they are only accepting crypto, you know what I mean, or something like that, like maybe, and maybe if these are NFTs, that they're buying and selling, maybe the setup makes sense. But what's interesting is, number one, the way that they indicate and highlight that they've got a tremendous amount of insider or existing investor interest. That's something that's so powerful for founders to communicate and signal, because like that says, the folks that have seen the story play out so far are like hungry for investing more. That's great. That's a great sign. So I like the way that that's characterized. The second piece is the overall dilution on the round. So, Jillian kind of went into this and Mercedes as well. It's just, typically, rounds end up being 15 to 22.5% dilution in any given financing. Sometimes it's 10%, sometimes it's 25% based on progress and all those things. This round, I would probably actually expect, for what it's worth, to potentially end up being a little bit of a larger raise, to be honest. You know what I mean? Like, I think if I were leading this round, like let's pretend I was leading this as like a Series A, I'd probably ask them to raise a little bit more so that they can make their insider investors happy and I can get to like more meaningful ownership, because I think the overall dilution on this is not going to give it a lead enough ownership. So, lead investors, and I see a few questions with respect to kind of lead investors. Lead investors will typically articulate up front like what their target ownership is. And so more often than not, the way a raise and an evaluation is determined is really kind of a cross-reference of how much ownership, the investor is looking to target. Number two, how much you as a founder want to raise. And then number three, how much, dilution, as a founder, you're willing to accept. I wish I could tell you that it was based on company fundamentals and progress, but more often than not, it's like a triangulation of those three factors, particularly at the early stages. So if we said this is like a 900K round on a $7 million pre, oftentimes those types of rounds are very much, predicated on, I'm a lead investor and I'm looking for 15% ownership. And I write $1 million checks. I'm a founder. I'm comfortable raising up to $2 million, and I'm comfortable with 20% dilution. Like, that's really the price discovery, more often than not, is like that art as opposed to science. So I will pause there.
Thank you so much, Peter. That was amazing. And apologies, because I do think you got a Series A1 and I must have put it in the wrong space.
It's all good. No, like 900K, like that could just be like a really healthy seed. I would do that seed at 900K.
Hey, you see,
sign up.
Companies, call it the seed and raise a big round.
Definitely. Yeah, I'm in.
All right, Rich, on to you for our Series A framework and case.
For sure. Yeah, I think when you look at this slide, I think the first thing that rings true to me is the framework for a Series A evaluation and seed have a lot of overlap. There aren't that many different things. They're just different things that you get to evaluate from a seed perspective. On the team front, I think that's, for me at least, it's always the most important thing. Jillian kind of prefaced it, I think, a couple of times in her session. Peter started there in his case. So it sounds like for the three of us, we're all in alignment of that's where we like to spend time. And I think that's irrespective if it's a seed company or a Series A company, that team is going to be pretty important. I think the difference here, though, is now time has passed. The product's probably been in market. And so now we can actually evaluate the team on their ability to execute what they said they were going to do. When Peter led that seed round, 12 months ago, did they say that they could have done, did they actually execute what they said they were going to do with Peter? And so that's a good indication of their ability to, one, execute, and two, recruit people to help them execute on that vision. And those are the ways that we think about evaluating that from a Series A standpoint. And similarly, for me, I used to be a Series A investor, now focused on seed, but regardless, we always look for, founder market fit. And we think that, one can get that, for us at least, in one of two ways. Either one, that person or that team has been in the market in that space for quite a while, and as a result have figured out some nuanced insight. Like in the case that Peter's went through, they seemed like they were folks from the art world and hopefully they had some unique insight into why they chose that particular problem point. The second way that we tend to see founder market fit work out is the founder or founders have had some sort of life experience that has decided for them to now go ahead and try to solve that particular pain point. And so usually you find that passion at either from a career perspective or personal life experience that allowed them to say, I want to go solve this problem effectively. Similarly, market size is very, very important here. I think unlike a lot of my peers, I tend to actually underweight market opportunity when evaluating a company. Not because I'm looking for small companies, but I just think in general, we as venture investors underestimate market sizes and categories way too often. And oftentimes we say no to companies because we think the market opportunity isn't large enough. And then we end up realizing that shifts had occurred that made that market opportunity much larger, or we just didn't get it right and how that sizing was. I think Jillian mentioned Uber. If you looked at the seed round or Series A for Uber, that was a black town car company. The black town car market in the United States is not that large. I remember looking at it back in the day. the market of people who need to go from places A to B is very, very large. And so it's super easy for you to not quite understand the magnitude of what an opportunity will look like in the early days. And therefore you end up saying no for the wrong reasons, unfortunately, and miss out on, quite lucrative investment opportunities. But similarly, like, there can be shifts in the market trends that actually favor a company later on. And so I think the best example we've seen in the last, call it 12 months has been Zoom. Zoom was founded in a world in which in-person meetings were the dominant meeting format. And as a result of COVID, they were all of a sudden the best product available in a market that was now coming towards them. Really hard to dictate, how that will change when you make that initial investment. But, investing in the right team and the right product can allow you to take advantage of market trends that go in your favor later in the future. And so things that we can now dictate and see at the Series A, because now there's been more time spent when that company raised that series, that seed round. Another example could be, Peloton, for example, or anything in the connected fitness space. They were existing in a world in which people generally went to the gym that worked out, and as a result of COVID, couldn't do so anymore, and things kind of went in their favor. And so being there in advance allows you to take advantage of that. Switching here to product for a second, unlike the seed round, virtually every Series A company probably has a product in market, with maybe the exception of a hardware business that takes just a tremendous amount of capital to get something in market. So like, my guess is if you went back in the day and looked at Tesla, they probably had no product in market before their Series A. But outside of companies that require that much capital, you can see a product in market, and that allows you to do demos of the product as a Series A investor, which we find particularly useful to see, okay, why is this so special? What is differentiated about what you're building today? And then longer term, we try and figure out what's the product roadmap here. And what we're trying to understand from that product roadmap is what's the wedge that you're using today to get into your customer, to then build out and own more and more of that customer's spend for your category. And then our viewpoint is, okay, do we believe that this wedge, this first product offering, is the right way to get into the company? And then two, do we believe that those ancillary products you want to build in the future are something, one, your team is capable of building, two, your customers will like, and then three, you have a way to get that to them effectively. And then on the kind of momentum traction thing, I think something else that's kind of more unique to the Series A round, where oftentimes, as Jillian pointed out, I believe, seed companies may have not even launched yet. They may not even be incorporated yet. That's how early some of these companies can be that we're looking at. And so by the Series A, products in market, there's traction that can be, determined either if you're, let's say, a consumer app, like let's say Snap or Snapchat, users, engagement, amount of messages per person, amount of referrals per person. Those are things that we look for from a consumer side of things. On the B2B side, it's definitely trying to get a sense for revenue, but also understanding, the second question here in the middle, how are you getting towards your customers here? Because you can get revenue, but if you're getting it in an inefficient manner or a very costly manner, you're actually just throwing money away effectively. And so what channels work well for you? In the scenario of Snapchat, it was just word of mouth. In the scenario of Uber, it was word of mouth plus your referral cash. I'll give you $20 if you refer Mercedes to Uber, and so forth. It's all those things were quite important from that perspective. And then, lastly, if we give you the 10 or $20 million you're looking to raise in that Series A, what are the milestones that you think you can achieve with doing so? And that's milestones can be financial milestones, but they can also just be, product hypotheses that you want to test out with this particular round of capital. And then on the financial and unit economic side, it's actually tied into that second question under momentum, which is, how do the unit economics work? If you are getting, $20 of net revenue or net margin, I should say, from your product for your customer, but you're spending 25 to get that customer, you're going to have to get that customer to spend quite frequently with you over time. And so what you saw, let's say, in the world of direct-to-consumer brands, that customer was an episodic buyer. They weren't recurring. They may have bought one or two things over a period of time. And so if you weren't able to kind of make a profit on that customer in that first order, it makes the math really hard to work from a customer perspective, which is why, for a long period of time, venture investors have gotten really excited by subscription businesses, because it's very tangible, and you can actually build in the ability to make up your CAC over a time period. Now, Generally, an investor wants to see you pay back your CAC in a 1 year time frame or lower, effectively. The longer you go out, the higher the chance that you lose that customer before you can make them profitable, and that's what people on the investing side tend to worry about, effectively. And then, yeah, on the deal front, I would defer that answer, honestly, to Peter's point on the last company, which was, look, it's how much you're looking to raise. The amount you're looking to raise is usually based on what you think you need to accomplish the goals you want to set out for the next 18 months, plus hopefully some buffer. Two, that Series A investors ownership target, generally it's in the 20% range, effectively. And that's not the round size, that's their check in the round. So the round dilution will generally be larger than 20% at that Series A. And then, lastly, I don't think Peter touched on this point too, but it really depends on, how competitive this deal is. So by the combination of the team, the traction, the market, and those confluence of those three things can make your company extremely hot for this fundraise. And therefore, logic can go out the window in terms of valuation. Your stance on, hey, I need at least 20% goes out the window, and you say, you know what, I just need to be in this company. And that can lead to a lot of price appreciation for the founders, which is fantastic for the team and the founder in that scenario. And so I know we're running out of time, so I try to go kind of quick. I did not look at any of these questions. And so
let's move on to the case, and then maybe you can answer some of them as you see them. I'm unsure if the Zoom is going to cut off at 2. It might. So let's try and wrap it quick. Go through the case relatively before 2.
Sure. I will do that. So, top line here, this is, obviously an SMB SaaS company, and specifically, it's a company that's trying to provide automated bookkeeping for SMBs. So, what I can kind of gather there is it's, fintech software to make the life of a relatively small business owner much easier. And why this is generally attractive is because if you're a small business owner, your forte probably is not accounting or bookkeeping. And so it's something you have to do, don't necessarily know how to do it or want to do it, but know it needs to be done. And so you need to find a solution to do so. So on the face, I think that premise makes sense. I'm going to go the same path actually as Peter did as well, starting on the team here. So, it's a solo founder here with a CPA and former CFO. And so when I think about that founder market fit, it seems to ring true. He or she has probably been in the space for a while, understands accounting practices for small businesses, having been a CPA and CFO. And so those lights, kind of ring true to me and figures, okay, this is the right person in theory on paper to be starting this company. And then I think through, okay, the pain point I've articulated to you before is that no one wants to be doing bookkeeping when you're a super small company. It's not something that you're focused on, but obviously you have to do it. You want to make sure you're paying taxes correctly and you aren't getting penalized for being audited and doing your taxes incorrectly. And so that's the solution that this company is effectively trying to solve for, which once again makes sense to me. The questions I have really come about, how do I think about you attacking this market? So yes, at the very top of this slide here, there are tons of companies that in theory could be customers for this company. But 2, they're very small companies, or 1, they're very small companies, and 2, they can't afford to pay very much for this offering. And so you need to make sure that you can provide value to these customers without having to provide very expensive customer support. And anyone who's had to sell software to SMBs, they know that SMBs can be very painful from the customer support perspective. And so something you want to think about and worry about when evaluating a company that's in the SMB space, because in theory, lots of potential customers, but also lots of potential headaches when it comes to customer support, but also too, in terms of actually reaching them. Like, try to think about a company that has 1 to 19 employees. Those are hard to find and really hard to find in a cost-effective manner. And so what you really need to do is make sure you have a very efficient channel to get to those customers. This slide really doesn't talk through how they want to go about doing that. And so what I think this company would be doing, or would be more efficient for them, is going through actual accountants and say, hey, accountants, can you sell our software on your behalf? Because we'll make your job easier, make you able to actually service more customers via our software. And also you can be a channel for us to sell into these SMBs, and maybe we'll give you a cut of our revenue for doing so. And so trying to find unique ways to kind of get your product in the customer's hands for very, very cheap or zero cost is going to be paramount when thinking about any company that sells to an SMB, because they're hard to find, and they're also very, very painful from a customer market perspective. One thing here that's, I think, a very important point here is, organic churn in SMB is 30%, as is stated in the slide here, which means that no matter what you do, every year, at least 30% of your customers are just going to die or go away, which means each year you have to go find that new company that's an SMB or find existing customers that you didn't know before. And that can be quite costly when you're having to basically get back 30% of your customer base every single year, which is why churn is a very, very big focus for folks that are investing in a company in the SMB space. And then, coming back down in terms of just the solution here, once again, I think it's a very straightforward solution. The problem, though, is that it's so straightforward that lots of folks are doing this or attempting to do this. And so understand the competitive landscape and why this particular company and product is the best product in the market is going to be very, very important, because you're entering a very, very crowded field, and it's going to be very hard to differentiate in this category. Now, the flip side is you could make the argument that the category is so large that there can be multiple winners in the space, but generally, venture investors are trying to figure out who is the winner in the space and not trying to play for second or third or fourth place here. Going down the traction, I think, look, as articulated here, this is really good growth for this company. I don't know how much they've raised prior to this seed round, the Series A round. One thing I think we've all seen in the seed space is that companies are now raising, a pre-seed, a seed extension. So they end up raising, $6-7 million before they can even raise that Series A. And what used to be efficient growth may look inefficient these days. But on just the numbers they've articulated here, this is, impressive growth. I think, any Series A investor would pay attention to this company, spend time on it, and dive deeper. But I think where they spend most of their time is on this competitive landscape, differentiation, and then understanding go-to-market. I think those are really the three things that at least me as a Series A investor would spend my time here evaluating. And then lastly, on the raise here, $10 million Series A to $4 million pre, I think that would have been a pretty standard Series A 2-3 years ago. Very non-standard today in today's market, particularly if the company is growing tremendously quickly and to becoming competitive. And so I imagine Peter putting his General Catalyst hat back on, or Jillian putting her Anthemis hat back on, would have been like, I would love to pay this for most of my Series A's, in the past 12 months, but those probably are hard to come by, or even Mercedes too at Lightspeed. I'm especially seeing very few things priced like this these days. But the thing I mentioned here, though, is they have one term sheet and expecting another one eminently, which means I, as an investor, has gotten into this particular fundraise late. And it's always a challenge when you get to something late to kind of make up ground, to prove to that founder that you are the right partner for them, as well as the ability to kind of do your homework and diligence to get comfortable to say yes and say, I want to invest in your company. I want to be on your board. I want to be helpful to you. And so I know I jumped around wildly on this slide, but those are my quick thoughts on this particular company.
Thank you so much, and for going through that. And so I'm going to flash up also the panelist information. Please go follow on Twitter. They tweet really insightful stuff. I follow all of them. So with that, I'm going to stop sharing the screen, and then we have a few minutes for Q&A. Apologies, I think the webcast is going to cut off at 2. I thought I was going to go a little longer. So what we'll try and do is answer some of the Q&A questions, and I'll just read some out, maybe group a couple, and let's see how many we can do in 3 minutes. So one of the questions in there early about the seed was, how much should we ask for it during?
I think we lost you there, Mercedes.
I saw he coming. Oh, you were typing it. Did I break up?
Yeah, you did, but you're back now.
Yeah.
I think there's multiple ways to answer this question. I think one is you want to know what a seed or Series A investor is going to want to see in that next round, and then figure out, one, how much cash it will take you to actually hit those milestones from both a product perspective as well as growth metrics effectively. And so I actually worry when a founder asks me how much they should raise. I think they should have better command of their business and have a better understanding of what they need to take to get to that next level. And so I always want to see them answer the question rather than getting advice from me on that.
Someone said, Michael, when it comes to MVP, are there a set of benchmarks you use when it comes to evaluating it? It's a bit open-ended. Anybody? We can come back if folks want to answer a different one. Another question, I'm going through several of these. How frequent do existing investors participate in future fundraising rounds? Does it look bad if a lead investor invests again in future rounds?
I'd say the opposite. You typically want investors to continue following on. Maybe they led the seed, they probably won't lead the Series A, or I mean, if they're a multi-stage fund, they could. But it looks a lot better if they are, because it means they continue to show conviction.
I agree 100%.
Another question from Sharad. If a company is getting the vast majority of customers through paid ads, is that a red flag, or do you just decide via their margins? My thought on this one really quickly is it depends. I think at later stages, it actually, sometimes the later stages, it helps with predictability and being able to actually plan what targets you're going to hit. In the earlier stages of business, I typically want to see more organic and know that there is some initial flywheel and kind of customer love driving them. But not to say paid isn't good for a late stage. Anyone else?
Yeah, I think I agree. I think at some point you want to see like some sort of flywheel and other ways that you're able to get customers, but paid isn't necessarily a bad thing.
As long as it's economically viable for you, it's not a negative.
Looks like we've hit 2 and we're still here. So minute of truth. Another question is, how frequent do existing invest? Oh, we just answered that one. Okay. Good reference materials. Okay. Biotech. I don't think any of us cover biotech life sciences, unfortunately. And what else? There's some questions in the comment areas. Someone said, what about the Series A case study raise was not typical of what we're seeing today? I think, Rich, you answered a little bit of this, but maybe you can go into more detail about how the Series A raises have changed.
Sure. I think what we've seen is that there's just more funds looking to write Series A investments. And so that competition has bred the fact that companies can now raise a lot larger round at their Series A, and larger raises tend to kind of commiserate with larger valuations. And so I think we tend not to see companies raising $10 million Series A anymore. It's like $15 or $20 million Series A's. And that's a product I just mentioned before, but also too, I think companies are getting further with seed rounds these days as they've become more efficient in terms of getting from 0 in revenue to $1 million a year and even further with less capital. That's kind of given us as an investor confidence that, you know what, you're actually able to hit product market fit earlier than you could 5 or 10 years ago. And I'm okay rewarding you for that, particularly if I feel that, the opportunity, the upside for this category is much large. I'm going to worry less about having to kind of be as onerous on valuation in that particular round. Now, once again, I don't necessarily think that way at the seed stage, but I think that's what's happening with the Series A. And so I'm generally a more really price sensitive investor, which not every founder likes, but that's just how I would answer that question.
I'd also push back on that a little bit because seed rounds are getting larger. So you're also just seeing companies raise a lot more. So like
before the Series A, yeah.
Yeah, exactly. So prior to Series A, if previously they only had like $2 million to get to certain benchmarks, that was one thing. Now like they have $5 million, or they're raising, as Mercedes said at the beginning, like there's now institutional pre-seed. So you can be using like a 2 million pre-seed, then a 5 million seed, and then getting to the Series A. So sometimes it's like they've actually raised $7 million by the time they're getting to a Series A, which means that we're seeing hopefully a lot more traction by the Series A at that point.
Yeah, I think also like if you look at a Lightspeed or a GC where Mercedes is at now, Pure used to be, when their fund sizes are as large as they are, I don't know exactly what they are, but I'm going to call it $1-2+ billion. Running a $10 million check in of itself is not enough or meaningful for their fund sizes, because if you return 10x on a $10 million check, that's a $100 million return out of a $2 billion fund. You've barely made no dent into that. And so, firms want to be able to write checks that can, if successful, move the needle for the firm. And so I think just the nature of that math has also gotten our investors wanting to see founders be able to raise more, but not just for the sake of raising more, but actually, if I say, hey, I can give you 25 instead of 10, could you actually use it efficiently, hit larger milestones to make that subsequent round less dilutive, is I think also coming at play in the last 18 months change plus effectively. Peter's always pushing people to raise more money. That's the thing, you know. Blame Peter.
That's not the case. Can we actually hit this question about team really quick? Because, you know, for what it's worth, I mean, hopefully this is a little bit of it too. And I think, you know,
Sorry.
Jillian. Oh, can you hear me okay or no?
Go ahead.
There's no bueno.
It's my internet. Go ahead.
Okay, no worries. No, I'm like, I've got like, it's like a million tab kind of day for me, which is unusual. So it could have been me. But just, you know, I think this piece is really important because this is also, I think, you know, to Jillian's point, how and why some of the earlier raises are larger and larger, because companies are able to do more and more with no capital effectively. And so if you're able to like finagle together like a team of 5 people, you know what I mean, and generate some flavor of a product, all of a sudden, you know what I mean, like your first round, you know what I mean, could be $4 million at a $20 million post, and thus your Series A, you know, then is going to be, you know, 15 or $20 million at a $100 million post. But with respect to resources on this front, I mean, first off, I actually think the Equal Ventures team may have like almost like a blog post or like a toolkit or like a book list, which is incredible. So I would probably reference that. But I would say there are a handful of books like, you know, like the Culture Code and others. Like, I think it's like, there are just so many great books, you know, from like the talent and people leads from companies like Google and others. Coda is a company that publishes a tremendous amount about hiring and culture. Third is I would read anything and everything with respect to Stripe, because I think, you know, the cat's getting out of the bag, you know what I mean? Like that, this is like one of the best high caliber teams like ever assembled in like the history of company building and the internet. So, and they've got lots of their cheat codes like online and in blog posts and things like that. So I would become like a student, you know, of Stripe, so to speak, if I were in your shoes. And then the last is I would look at, this is where I think becoming friends with near peer founders, you know, think like Series B stage founders that have built teams and cultures that you respect and admire. They were in your shoes, you know what I mean? Like when they were 2 people or 3 people. And so, and chances are they made mistakes, you know, a tremendous amount of them, in fact. And chances are they found some things that worked, you know, that they can hand to you. So I always love that learning by osmosis from near peer founders, because it's very practical advice and it's also timely advice. So, you know, because they, you know, versus asking a public company CEO, you know what I mean? Like, hey, what was it like building your team and processes really early on, which they're going to forget. So.
Yeah, no, I agree completely with Peter's point, particularly that last point on the peer side, because like you can get advice from that investor in that standpoint, but incentives are not always aligned there. And so they may not be giving you the best advice. 2, they may not even been in your shoes before. And so probably gonna give you poor advice in that scenario. And whereas your peers, they're used to dealing with, you know, different types of people in their companies, different investor sets. And so they probably have some things that will help you be more effective. And honestly, like starting a company is fucking lonely. And so having even a shoulder to cry on or someone just vent to, even if you're not looking for advice, I think is going to help you as a founder in terms of your mental health. And so I think just being able to do that, even if it just means, hey, listen to me for an hour and shut up, is quite helpful in of itself.
Let's see. In terms of additional, Peter, what book did you mention?
Oh, I mean, Culture Code, this is making me think I should maybe just assemble it into like a Goodreads list, you know what I mean? And maybe share it with the group in the future. So maybe if folks find me on Twitter and like DM me, I'll like try to cook it up. It won't be like exhaustive or perfect by any means, but yeah, I like books for some of this stuff. But Culture Code, it's like incredible about hiring, you know what I mean, and early team culture. The Secrets of Highly Successful Groups by Daniel Coyle, like a librarian, you know what I mean? Here we go.
And let's see what else. So many questions. It's hard to answer which one. So there was a question for if you have a product, but you don't have traction yet, basically you're pre-launch, how should you think about funding? I don't invest in these type of companies, so unfortunately, I don't have a good answer.
Yeah, I'll have thoughts, and I know Jillian will have thoughts too. I think it's so the question's around like how to kind of like motivate like a raise kind of like pre-product in a way. I mean, I think one is, assemble an incredible team of like advisors and get as much of your team together as possible so you can tell a really compelling team story, because like that sometimes can get you like the 250K to 750K you need to get up and out, out of the gate. So think about what you have as kind of proxies for progress and trust. That's a framework I always like to use, proxies for trust and progress, and sometimes that's like, the way you tell the story about your background and why you're the best person in the world to be building, something. So I think that's number one. Two is outline as much as you've been able to do with $0. You know what I mean? Like, so it's like, oh, we got the Amazon credits and we did this and we did that. We called all these people, like basically show that you've exhausted everything. You know what I mean? As much as possible, without raising outside capital, I think is a really important aspect of the narrative. I think the third is you want to target your outreach to folks that do this style of investing. So I do a lot of this investing to people of thoughtfully designed, you know what I mean? Like presentation. Oh, that's the other thing. Over design your deck. You know what I mean? Like I would say, each of us, look at 10 trillion, you know what I mean? Like presentations in a good way. And we learn and appreciate each one. But the ones that show like, oh my gosh, like, no, I don't have the product built, like, because I kind of need 750K, but it's like, I've been like polishing, like the most thoughtful deck in the world, you know what I mean, for the last like 2 weeks, and it's like super crisp. And so, I would even consider, getting a design friend or like, or even investing like $5,000, like put it on a credit card and like get a design firm to do it. You know what I mean? Like I've done that. So I think it's that powerful. So, because it helps you kind of, again, proxy for trust and progress,
I think the
Yes.
deck thing is especially true from like a consumer standpoint. Like if you're building a consumer business that has like a brand to it, and then you show up with like a janky looking deck and you can't represent a brand, like that says something. And so just kind of thinking about how you're able to show yourself and you're pitching yourself and like this vision for the company. Because as you said, like there's nothing necessarily there. And so exactly like, why are you the ones back and like, what are you building long term, I think is really important. And like, what to Peter's point, like what have you built to date or done to date that gives us the confidence in you? So like doing all the user testing research that you can possibly do, like going out and talking to who your customers will be and understanding all of the pain points and kind of digging into that as much as possible. And just trying to collect everything you possibly need so that you understand exactly like what this is going to look like once you can kind of hit the ground running. It is super important.
Yes, cannot overstate the importance of a good looking deck. We're really simple SVCs, like just show us something pretty, And let's see, any other burning questions folks want to answer from the panel? Otherwise, I know we've taken over an hour of your time, and I appreciate. I know we didn't get to all of the questions, but please feel free to continue reaching out if you have any specific questions. I'm available to answer questions as well. And there were a lot of questions about, is the deck going to be shared? Is the recording going to be shared? Black VC will be getting back to you on those questions. And this is a great last question. Many most memorable pitches. Let's leave on a high note. Anything exciting about pitches that we saw? Trying to think. There's most memorable bad, but I'm trying to think of most
the most memorable to me
good.
are always the bad ones. Those are the most memorable.
So true.
Like I had
got
one founder. Go ahead, Peter.
No, go ahead, Rich. No, it's a good one. I love when pitches basically start with turning the tables. You know what I mean? Where it's like, it's almost like you give the venture investor a pop quiz. You take out a notebook and you start basically asking them questions like, hey, I sent the deck ahead of time. You know what I mean? Like, I'm sure you've had a chance to review it. Like, what are the 2 or 3 key questions you have so we can dive right in? And when they do that and they have a notebook out, I'm kind of like, we mean business.
The one pushback I'll have on that is don't ask questions that you can find your answer to yourself. So if I have my check size and fund size on the website and you're like, what's your check size? I'm like, no, you've just lost. And so You don't want to ask the wrong question. This is me. Once again, every investor is different. And so Jillian may think the opposite of me that I do than Peter. But yeah, to your question, Mercedes, I think most Merrill pitches are bad ones, not good ones. So
Yeah, I don't mind the check size, not on our website, but people ask for my email address a lot, and I'm like, it's on the website. So I don't like responding to that one. Well, thank you all so much. We had almost over 300, I think 315 people with us at point. So thank you all for staying so long. Hope this was insightful. My email's on my website, invent@lsvp.com. Feel free to reach out. And thank you so much, Peter, Jillian. Rick. It was amazing. I learned so much.
Thanks for having us.
Thank you all.
All right.
Great to see everyone.
Bye.